This next panel is going to be a little different from the usual setup. Instead of having a typical Q&A panel, this will be a discussion made up of different types of investors talking about what they do and how they support each other. This is the Investment Roundtable, latest investments results and what it means for 2020. A follow-up on the discussion from the previous panel, this roundtable brings together different profiles of investors to discuss their investment theses, takeaways, and opinions on the crypto space. They will also be sharing their experiences from the last few years and how that affects their fund deployments moving into the future. If you have any questions for the panel, please go to www.slido.com, enter the code BlockShow2019, select stage 1, scan the QR code on the screen, and simply write down your question. This panel is also moderated by Roland Yao and features panelists Richard Wang, James Wo, James ZHANG, Ray DENG, and EDITH YEUNG. Please welcome your panel.
I'm back, and this is a continuation with another all-star panel. Richard Wang, James Wo, James ZHANG, Ray DENG, and EDITH YEUNG. Their details are, again, on the website, so I won't spend time going through that because we have some very exciting stuff to discuss. I'm going to put a couple of things out there for everyone here who are very experienced investors in their respective space. Just now in the previous panel, we talked a lot about speculation, fundamentals, the way to look at equity investments and token investments. So let's set the stage here among each of you in terms of how you view traditional equity VC investments versus a blockchain or crypto-focused investments. Is there a difference? I mean, do we need to separate that, kind of continuing what the last panel discussed? And how do you guys, how does everyone here build into that thesis and that strategy? I'll let it discuss among yourselves. You can kind of pick who wants to come up first and talk about your strategy of deployment.
Oh, okay. My name is Richard. I come from DraperDragon. Well, actually, we are a very traditional venture capital, so I guess we have a lot of experience about this topic. Actually, we do, if you heard about the guy called Team Draper, right? We are the mother fund called DFJ, and the Draper associate was from Silicon Valley. And we do this for 35 years. The reason I said that is because to show you we are really traditional one. 35 years for venture capital. And we, as a DraperDragon, actually we are in China, do the venture capital for 15 years as well. So we are a very traditional one, very typical and focused on technology-based early stage venture capital. And so yes, I would say there's some difference bringing about the traditional venture capital and also the so-called crypto fund, or actually we do have a fund we call digital assets fund, was registered in Cayman. We have a different thesis to do the equity investment, investigation or due diligence, and we do another way, another algorithm to survey those token deals, or say crypto deals. So it would be different from the due diligence way. It would be very different, and from the way we look at the market, we look at the team, and also look at the technology. That would be different as well. So simply to say, yes, it's quite different. We do have a separate team as well to handle this.
And is that also separate investor base? Is that a separate?
Separate fund, for sure, because you have a fiat fund, all right? Fiat fund normally is focused on equity, and we also have a so-called token fund that will focus on the token.
Do the rest of the panelists agree with that strategy? How are you running your deployment?
Yeah, I think for us it's a little different. Hi, I'm James from Black Panther Capital. So we're a multifamily office, and we have a fund-of-fund vehicle in crypto. So for us, traditionally we invest in the Chinese TMT sector, deals like WeBank, Pinduoduo, pre-IPO stage deals. So for crypto, our strategy was, it's such a new industry that there's such allocators that have been in the space for a long time, and we wanted to give these allocators full discretion to deploy. So we started a fund-of-fund vehicle that deployed to some of the top fund managers in North America. And I think, in terms of VC investments, we represent 36 family offices. So generally for them putting money in crypto, it's like you allocate around 1%, and for our fund of funds, it's more of a stable return. So the way I look at it, everything is venture right now. Any of the deals in 2017, 2018, the secondary market is very illiquid. Even if you're a venture fund, it's maybe marked up on paper, but it's really hard to exit at the moment. So for us, we invest into hedge funds like the Metastables, the Scalar Capitals, guys that can buy tokens and are very liquid, but also have maybe around 15 to 20% in a side pocket where they can exit at their own discretion and then return the money to their investors.
So the crypto strategy there is the liquidity part of a more illiquid VC, traditional VC portfolio.
Exactly, because I think if you want to actually hold tokens and represent a more institutional product, you have to have a custodian, you have to have all the service providers, you have to have MG Stover to do auditing for the funds. So that's the kind of the guys that we invest into, and that's kind of risk management we do for our family offices.
So I think if to do the comparison between a traditional VC versus focus on investing in token, I think the biggest difference, particularly for more traditional VC, which most of the traditional fund terms is 7 or 10 years, a lot of the token investment in terms of exit is a much shorter cycle. So many of the traditional VC in the past don't really need to think about, or even you do exit, it will be the cycle is really, really long, but instead a lot of the token projects, literally from a few months up to within a couple of years, there is actually a potential exit there. And I found when we first got into crypto, wow, there's a whole universe of trading on the token economics that we have to learn from scratch. And then second, I think if you think about it, most of the token-related projects are all on the protocol level, and their target audience are actually developers. So we found that we need to hire very, very different kind of folks to do very technical due diligence that a normal deal, a normal VC, you don't really have to do. And then third, this is really one industry. You get all the governments, all the big companies to have to redefine, and they all get super intimidated. So we found that we almost need to have a very strong opinion and really keep track of regulatory-wise, worldwide economic policy. That in the past, whatever they invest, you don't necessarily get the government to challenge you that much. But so it's super interesting to see.
But on that due diligence point, doing all the technical due diligence, understanding the value of these protocols, it is a very technical process, versus the exit value, which we discussed in the previous panel, has a big speculative element to it. Does it connect? Do we need to do that much diligence to realize that short-term value if we're going to trade on these volatile margins?
Well, if I can say that, we still do quite a heavy due diligence about this part. Though, as mentioned, right, the token deal has a better exit strategy or better liquidity, right? But for us, again, we are quite focused on the technology base. So even for those so-called public chain or whatever they do in the infrastructure protocol things, though they may be able to be listed on secondary market very soon. However, there may not be a good value for us to exit anyhow, right? So to be a very technology-based venture capital, we actually do quite heavy due diligence, especially about the team as well.
You earlier almost had something to say on the traditional VC versus...
Yeah, sure. Hello, I'm James Wall from DFG. We do three things. One is investment. The second is ETC. The third is a bunch of different startups in China. So based on our experience about investment, I think about this question in a different way. Like the most important, basically, question is what is the basic valuation model of the industry, or how to clarify what is the asset of the token, right? if we, traditional venture capital is, put money into the startups in exchange for the equity. So, but, if you get a token which be valued at like it's kind of like a STO or like a security, you can, compare this to the traditional VC industry. But if you buy in Bitcoin or you buy in Ether, that's probably, internet money or commodity, whatever. It's a whole different logic. So you just cannot use traditional venture capital's ways of doing things to buy these kind of coins. So, I mean, for the basically question, we need to clarify what is the asset will look like. Then we can answer the question then, oh, okay, is there any difference like between the traditional VC or the VC in this industry, or is there any, the last question, do you have, DD process? For sure, you need to have like actually more DD process. If you are buying gold, you need to check more. If you're buying companies in one country, like 1,000 people, but like only like several facts will influence the company. But if you're buying gold, there's like so many uncertainty. Like there could be a war in some two small countries will influence the price of gold, right? You actually need to care about more when you're buying gold, right? So Bitcoin also similar logic. So actually, if you're buying, I guess internet money or commodity, I mean Bitcoin or Ether or other kind of like a cryptocurrency, if it's not a security, you actually need to do more DD. So that's my view.
Okay.
Right. I'm Ray. I'm from Duke Capital. And actually, as a pure crypto fund, I'm surprised to find that I'm the minority here. It's very different from last year and the year before. The foundation of our fund is actually built upon our few very successful ICO investment back in 2015. So we're like 100% crypto bred, and also very deeply plowing into the vertical layers of the industry as well as the horizontal ecosystem of it. I think the beauty of the industry is that it democratizes the participation for everyone. But the difference is that the resources attributes that everyone bring to this industry, or what are you looking for to gain in this industry, and also I think we are probably very rare in this industry as we are very long-term minded. We're still holding our maintaining our position from 2015 and 2016, and those are doing really good for us, and we want to continue to do that in this industry. So. Yeah.
And that long-term view, that's a lot. That topic has been discussed a lot. In that it needs time. Let time do the work to let a lot of these protocols and projects come to the mainstream. I want to ask about liquidity events. So we talked a lot about short-term liquidity, listing them on markets, playing in again in the volatility. But long-term wise, when we're investing in a 5-10 year horizons and looking to the IPO. ICO and M&A activity, typical, at least currently, we see as liquidity events. What are your views on these channels, or where new channels come up? How do you exit your investments and explain that to your LPs? Money on money. How does that work in a lifetime of your funds?
I can start this one. I think. If we're going to do compare traditional investing and investors coming in from the traditional space to crypto, and something really important to take note of that I think is overlooked is that your investment has to outperform the beta of Bitcoin. So say you're a venture fund, you're 10 years, all your investments is benchmarked against Bitcoin at the end of that day. Because if I just buy Bitcoin today, honestly, you'd be up like 40% year to date. And at the same time, you could also be down 80% like last year. So that's why I think funds risk management is really important. So for us, we have two fund of funds. The first one is investing in the traditional kind of like fundamental funds, we call it, where 80% they trade tokens. So say our fund managers into privacy tokens. They might buy Zcash, Monero, whatnot, and 20% are in side pockets where they're in Polkadot, Algorand, and a couple of the hottest projects last year. And I think a note there is that you don't want to be in multiple of these same fundamental funds because they're pretty much all in the same side pockets. So you're paying $220 for the same fees. On the other side, it's like we have our quant fund of funds where the ARB, the alpha of Bitcoin is so high to do a market neutral strategy right now I think it's only probably for this year or next 2 years that a lot of really smart guys, we see coming into the space now, like X2 Sigma Trader or, X Bridgewater coming in and deploying strategies that they used to do for billions of dollars, and now they're doing it for a relatively new industry with a 240 billion market cap. So I think there's two ways to honestly look at it, and depends on your risk portfolio. So for our LPs, if they have a high risk portfolio, they want the data of the industry, I honestly tell them, go buy Bitcoin, find a custodian, a custodia, don't sell for 10 years. But if you want risk management, you should look at more into a fund-of-fund structure, whether it be into quant funds that are market neutral, that can do 30%, IRR, which is amazing compared to the traditional sector, or you put it into like the hot projects and hope to exit one day at like a 10x valuation.
And that 10x valuation on the liquid stuff, where would it come from?
Yeah, I guess I'm the LP, also the GP, so we got some flexibility here. But yeah, it's really the headache for the liquidity problem. We started like an $80 million venture capital fund like 3 years ago. We got like a 3x return, so it's $250 million, but it's illiquid paper money. So I can.
That's cash, money on money.
Yeah.
Not IRR.
I can show off, but it's not a real money. So it's really the big problem. So from our position right now, we try to reallocate our capital and sell those kind of equity and allocate the money into the token side. I think tokens and coins have way better liquidity than equity. We got like the first IPO actually Silvergate Bank, just listed on New York Stock Exchange, which is kind of like a blockchain company, but it's a bank. So it is a big problem for the equity side, for liquidity problem. When we value token, for like security tokens, you can get a same kind of valuation model of the equity, but for sure it will be easy for you to get listed. So it will be easier for the startup to raise money, for the individual to invest into the kind of great companies. So it will benefit both of the party. So actually, security token is better than kind of equity on that side. For the others, like which is not security token, like Bitcoin and Ether, the valuation model, from my understanding, is kind of internet money. So basically, you calculate the valuation of the internet, multiple the valuation of the money, then you will get a kind of like a simple formula about how
and in that example, if it's internet money, it's all digitized, it's all in the clouds and in servers, is there a need to bring it back out to fiat? I mean, is that a direction that you're seeing, that maybe this liquidity discussion, we shouldn't be just stuck on cash liquidity? Are we seeing a future where, because we don't necessarily have to have cash to transact, liquidity can come from other forms?
Yeah, that would be the final stage, I guess. When they realize, we should have like 100x about our, investment. We don't see massive adoption, at least for now. Bitcoin is like a digital gold, kind of like can replace gold somewhere. But we just cannot see any, cryptocurrency which can replace fiat in our like daily life for now. Because we fail to solve the scalability problem, we fail to find the use cases. It's really a long-term question. So, but we will see this happen eventually, probably like 20, 30 years later, I guess.
And so for each of your funds, when you explain to your LPs about this investment, do they ask about the exits, and how do you explain it to them for the crypto piece, blockchain piece?
We don't have LPs, but I think in terms of liquidity events, there's no shortage of crypto projects and blockchain companies that's been touting with the idea of finding liquidity on the traditional equity market ever since like 2013, 14. And also recently, there are pure token projects flirting with the traditional equity market via the Amon ETP projects on the Swiss stock exchange. And also like to take this opportunity to congratulate our portfolio Tezos on recent listing. And also, we've been reading news about these miners getting listed, or some exchange doing backdoor listing. So I think this is something that the projects or the capital behind them wants to, the direction they want to put them towards. But I think the question that I have is for some of the pure token projects, are they able to meet the listing requirements on the major exchanges? And also, why would they pursue that since the likes of Blockstack are trying hard to obtain the SEC approval of their Reg A? So these are the things that I'm trying to understand better. But we do observe a lot of other kinds of liquidity events going on, like major public protocols buying out other smaller public protocols, eyeing on slices of their technology, or public companies. They want to absorb a certain crypto teams with the products that are building into their mothership. So we expect to see more of those events happening. Yeah.
Lots of M&A and backdoor listings.
Yeah.
Edith, you're about. Richard.
Yeah, you know what? I don't think this is a real problem because when you trying to raise a new fund, you have to define the position, vision, or strategy of this fund. If this fund is focused on technology base or focused on equity, and when you assemble this fund, you define its 3, 5, 7, 10 years. Based on this kind of positioning, you look for your LP. So LP understand if they get in, right? So actually, I don't think that would be problem. That's why I say earlier that we have a so-called equity fund, and we have separate token fund. For separate token fund, when we have this token fund, we talk to the LP. They understand the philosophy is different. So I don't think that would be a problem for LP.
Is the timeline for both these funds similar? Are they both long-term 5, 10-year funds, or
even for the equity fund, it has different timeline. For example, the PE fund, the short term, right? The so-called pre-IPO something. Sometimes it's 3 years. But if you focus on early stage, right? Say A round or before, maybe it's 7, 10 years. So, right. So it really depends on the positioning of the fund itself.
I think, like at the end of the day, actually our fund is focused on more on the equity side of. We tend to focus on a few areas. One is more on the finance side of like crypto. So we do digital asset custodies, exchange platform, where a lot of these is actually equity based. But I think what's really interesting these days is, last year was sort of crypto winter, and many of these projects actually are not necessarily raising money for token. They actually start more and more. I see is more reasonable valuation, but actually raising equity with a potential of a future token event. So in this sense, when we explain to an LP, hey, how do we get exit? Even though the mechanics of liquidity could be different to in terms of you sell, or even a lot of times you sell the tokens through OTC desk. But at the end of the day, M&A or getting listed is in the fiat world is sort of the same, except that of course sometimes you deal with token. There's different kind of mechanics, but the concept is exactly the same. And timeline is a little bit different. So in that sense, some of our LPs are obviously curious or learning more. Hey, how does all these things work? But the concept of even most of the token projects, they have lockup and various different terms. And nowadays, like they're public sales sometimes, and frankly, a lot of the early stage investor, if you're not more careful, sometimes we get screwed too. Yeah. So there's a lot of like fine print and things that we have to be aware of.
And if these markets, these being the traditional equity markets and token markets, have similar principles in the way they act, the one thing in the traditional equity capital markets obviously is a lot of rules and regulations and oversight to make sure the market performs fairly and equally. When that starts creeping into the token space, the crypto space, what are your views? Is that good news? Is that bad news? Will that assess away a lot of the BS that's out there and then focus on the good stuff? Do you welcome similar regulations and rules to manage token markets as they currently manage the equity capital markets?
Sorry, I was on another thought process. I just want to add to the last topic.
Yep.
I think we were talking about a lot of like smaller token investments that have not listed yet, through SaaS and everything. But if we look at a unicorn company right now, there's actually a very good example that is looking to list and is a crypto company, but will list on the NASDAQ, is Bitmain. So, we led Bitmain's last round, B+ round, and right now they're looking to list on the NASDAQ in probably Q1, Q2 of 2020. And it's honestly the exact same process you go through with any other company. But that's the thing about crypto, right? Blockchain. It's early stage tech, but with liquidity. Bitmain's been around for 5-6 years. they're targeting, you know, like a 14 billion plus IPO. So it's honestly a lot of the same economics for, I feel like, for these large companies. It's just that in the earlier stages, how do you get in? For a VC, is it through a SAFT? As an individual investor, do you buy it on an exchange after the tokens have unlocked already? But at the end of the day, I think we will see some exits from unicorns in this sector. For exchanges, probably, you know, you got the Coinbases, that was like 8 billion. There's secondary shares floating around for around then. You got the BitMEXs, Binances, and I'm sure will exit and on some of the largest exchanges, traditional.
Sure. But it's still you know, there are avenues, but it's inefficient because it's still quite scattered. You have to have the right connects. So to the question about creating a more common platform, capital markets platform to trade on, which may require rules and regulations to manage that. What are your views? So that it does actually supposedly help the token listings. So they do perform in terms of the token market in a similar way as equities. Is that good news? To build pretty much the same capital markets but for tokens? To therefore allow for your projects to exit more easy? This is in the longer term view.
So just to throw it out there, and by the way, I am not a lawyer, so please do not take any of my advice. Well, like right now, there isn't necessarily like any issue for most of the tokens that get listed. I mean, the biggest, I guess, elephant in the room, which is also a billion-dollar company, is Binance. And most of the token projects want to get listed on Binance. But of course, what's really interesting, if you sort of, each of these various different countries started with the US, and they've been talking about it for a long time. But it's more or less, I think America is run by lawyers, so they always sort of trying to figure out a very specific rules to try to regulate as much as possible, and that's why many of these crypto exchanges just not supposed to operate in the U.S. or support any of the U.S. users because the rule is really, there's no rule for now, but they don't even want to touch it because of legal and tax reasons. And in the other extreme, there are specific countries like Malta, or I guess like Thailand or Philippines, that there are specific countries actually, or Japan, have very specific rules that to regulate and license for crypto exchanges, and they all have very different rules. So in some sense, I don't think projects have problem getting listed per se. It's more or less is longer term. Everybody's sort of watching. Hey, what's US going to do? What's China going to do? And I found many projects all domicile. They could be Chinese, but they're all domiciled somewhere in Singapore or Switzerland or Hong Kong. And rarely, none of these projects will domicile in the US because they have no idea what's happening. So in this sense, they already sort of work around it, but I think the whole industry need to pay attention as what's next to prepare when these big countries do endorse it. What are we going to do now?
So you have to play into that uncertainty. So in light of that liquidity, not uncertainty, but let's call it the development. Can you kind of generally talk about strategies? So we're moving on to the strategy part. So traditional investments, we have thesis, we have a story to tell. So it sounds like as a strategy for the blockchain side, a lot of the infrastructure stuff, the custodian stuff, the stuff that we need to manage these tokens, these projects, is an area as a strategy you want to invest in. For example, right, Edith? Talk about strategy generally, fund-to-fund strategies as a risk management portfolio. But how else can you look at it in another way? Directionally, where things will go by industry or by geography, by rules and regulations. What are the strategies available out there?
I think at the end of the day, no matter what industry or what you're investing into, it's risk management, right? So we represent 36 family offices, and the reason we did a fund-to-fund structure is because these family offices all want to invest into crypto, but how do they do that? If say the CIO, like let's take even a more macro look for the pension funds that are entering into the space right now, right? You got the Morgan Creek Digital just got another 60 million from the Virginia County pension funds. The reason that they can get these investments is because they have institutionalized kind of like grade properties. What I mean by that is they have the right service providers that traditional funds have. You got a fund admin, you got custodians, you got Ernst & Young doing your auditing. So only when you have these kind of like safeguards, then institutions can think about investing into you because they take no risk. So off of that point, for us, same thing. The first thing we look at is risk management. If a fund doesn't have the 4 kind of like service providers, it will be impossible in our LPA even to invest into these funds. And then second, if you go into strategy, it's like I said, risk portfolio. What's your tolerance? If you're looking for 30% return in the next like year or 2 annualized, you could definitely do it investing into a lot of these market neutral funds out there that have, that are extremely smart guys. But I will caveat that with the capacity. I don't think any quant fund right now can pass probably like around 20, 30 mil, just due to the trading volume and the market cap of the industry. Yeah.
Would you call that really a financial-driven strategy? We're looking at allocation, we're looking at risk, exposure, downside protection, very financially driven in terms of the way you look at the markets.
Yeah.
Any other ways of strategy thinking, picking projects?
Sorry.
Right.
Thanks. Just 2 cents on the last question, because that ties into strategy as well. We very much welcome more regulation as, the vacuum of the proper regulation last year and the year before sometimes put us into very vulnerable situations. So we definitely welcome that. And also, once that happens, we would like to look into more of those assets that under a robust legal framework. And also, Edith was talking about different jurisdictions, different policies. This is something that we've been discussing as well, which is policy interpretability. If different major regulators will come up with some standard rules, I think that will be very helpful for the entire industry. And I think as it stands, our fund is still very much focused on supporting enterprises that venture in the DOT. Obviously, I think the status quo is changing as recently the blockchain technology found its place in the big part politics, and also these heavyweight players are striding in. And that being said, I still believe that that creates a lot more opportunities for existing players already in the field instead of audience in the auditorium. So we're actively looking for those kind of opportunities and trying to create more values to our portfolios. And our signature track of investment is IoT, blockchain, IoT, synergizing. We will continue to look into that. And I think financial innovation is something I'm sure all of us will forever look at. The last thing recently that we put more emphasis on is endogenous crypto assets. And we're also looking for VR, 3D, AR solutions that boost the utility of those endogenous crypto assets.
And these industries are driven, it's because directionally these industries will continue to grow, IoT, VR, AR, fintech, and it's just that they require, in order to improve, they require that blockchain technology, that layer.
Right, the verticals in the blockchain industry.
The verticals?
Oh, yeah.
Understood.
Base layer is definitely blockchain technology, yeah.
I think, for the centralized service, it's kind of like create a financial service for the cryptocurrency and the blockchain industry. You got like an exchange which can create a bridge between the, fiat and the cryptocurrency. You got like a borrow and lending business, which also, will serve like a bank for cryptocurrency. So centralized business is very, you got a very like a stable growth for the centralized business. So if you got a good company which good at it, it definitely was, invest into it. For decentralized things, it's interesting that in most time, most of the decentralized thing didn't work at all. But the interesting story is like if some decentralized things work, it will be the only things matter. And it will be the very disruptive, the only things matter. Just like 2 years ago, Ethereum ICO. That's a very good example. So from my understanding, in the future, most of the public blockchain will die. Most of the use cases will die, in decentralized ways. My personal view is...
Most of the public blockchain projects will die. So
like a top 20 maybe will survive, but the rest will die.
Okay.
I mean, for now, my understanding is Ethereum is still taking a leading position about the public blockchain industry, and ETC will probably benefit from that. My prediction is like in 2-3 years there will be a killer app on Ethereum. So Ethereum is definitely worth investment.
Sure.
Yeah, about the regulation things, I have some 2 cents as well. As an institution investor, actually again, the risk management, so we enjoy the regulation because only regulation can protect us, okay? And we also pay quite a lot of attention, effort on the security token things because we do believe the security token things is a transition from the traditional equity to the older way, the so-called token stuff, right? The utility things. So it may maintain for 5-10 years something, but in order to help this market to go healthy or mature, it requires regulation. And about the strategy, as an old school venture capital, we enjoy venture. So we are not only looking for something that are able to get the short-term financial returns. That's not something is our first priority. We look more so-called value-added view, right? So we look at the project to see if the project are able to really find out some problem, solve the pain point as the old school way. Then we evaluate what kind of business value or commercial value is going to create. It may not be necessary as a physical revenue or profit like what we are doing today. But however, you need to solve some problem, right? And so maybe the community or some subscriber are willing to pay for something back to the community, so we are able to get some so-called commercial value. I would say it's different. The way we look at the commercial value will be different from old time for sure, right? But again, we continue to look for the philosophy will keep it the same. We check the project and see what kind of pain point, what kind of commercial value it create.
And do you apply that to, similarly what Ray was discussing, any type of particular industries? Is it something, do you borrow from the more traditional fund that you're good at certain geographies and industries to apply that thinking for blockchain projects?
Yes, and, actually there's a lot of sector, including insurance, for example, including the supply chain as well, including something like IoT, for example, just Ray mentioned about it. I can give some example like this. Today we're using quite a lot electricity and water supply from government, from public service. But nobody think about how about those IoT things, those sensors. There's no such central public service department take care of those things, collect all the data, right? It may not be happen, and it may not be necessary to happen. It can be handled by private enterprise. But how to using those data and create a value and benefit to all the communities? That's a very good project to do, I would say. Okay, just example.
Sure.
So more on the bigger picture, I think everybody should have a China strategy, and particular President Xi, now like about a month ago, really embraced technology as a whole, as a country. I think it's really, really exciting to see, although I don't think necessarily related to crypto per se. And to me, sometimes crypto is not necessary only for token. It's really the technology layer, which, by the way, I think sometimes it get kind of mixed up quite a bit because a lot of the retail investor started to buy and sell token, but really it's cryptography, about blockchain technology, security, privacy, identity. Yeah. These are things that is a very fundamental pain point that regardless, particularly for enterprises, that they're actually looking for solution. Right. So at the end of the day, one of the reasons why we are actually actively investing on equity side, I think, because there are a lot of super interesting, actual blockchain software where many industry are looking for solution, and although at the end of the day there's a big gap is a lot of the protocol that we have invested in for a few years ago, now they're all looking for use cases, and many of them unfortunately are super awesome geeky developers, but they have no idea actually how to sell and talk to enterprises. So there's a gap there, and we're seeing actually good quality enterprise. And by the way, the way that they make money is very just back to traditional way of evaluating either SaaS or licenses. So in that sense, I think that it's not that much of a difference. It's really about sort of how do you actually understand token economics. But we're seeing more and more traditional companies built on blockchain technology.
I think like just if you zoom out and look at the entire crypto, because there's a lot of stuff going on in blockchain right now. But as a fund of funds, when we took a look kind of at industry, and I think a really well-written piece, breakdown, full disclosure, Vision Hill Advisors, Dan Ziller, great guys, put it is like you can really break down crypto into 5 categories of funds to invest into right now. The first is the fundamental type of funds. So strategy-wise is 80% buy tokens, buy and hold tokens, sometimes trade, but not that active. 20% invest into kind of like VC-like investments, like seed round, and put that in the side pockets. So you would their lockup is about a year, but their side pockets could be exited in 2 to 5 years on the discretion. Second, you got the quant funds. Quant funds, you can break it down to a couple different ones. You got directional that will leverage trade based on Bitcoin's price movement. You got ones that are pure market neutral. The quant funds. You got the third one is smart beta. So smart beta is kind of just a twist where you put maybe top 30 tokens, and then there's a smart component to how you create this basket. For example, you can just invest into the Bitwise directly. The fourth one is something I think newer that came out last year that has caught on fire a bit more this year, generalized mining. So I think it was this term was coined by CoinFund and Multicoin, but essentially it's in a POS system. Bitcoin is POW, so in a POS system you can stake tokens and then make a return off of that. So a couple of networks that are live right now doing this, like LivePeer, there's a couple other ones, and there are some funds doing returns based on that. And the fifth one is venture, obviously. Venture investing, you can enter and get tokens through a SAFT, and that would be okay for your LPA and for investors, from what I understand. So yeah, if you take a look at all these 5 different types of categories, then it's probably like 600 crypto funds out there right now. About half, probably like under 10, 15 million AUM died in 2018 in the bear market. So it's honestly people who have survived, I think, through 2018, the funds that have either have a good portfolio or have raised enough money for them to be able to come on to this next bullish run. Yeah.
I want to, in the final 10 minutes here, move on to talk about results. I mean, the topic here is results. So we talked about strategy, liquidity events, which are some questions that came up in the previous panel. My next question happened to also be a question that the audience asked, which is, how do each of your funds measure success? Is it purely money-on-money performance? We did mention that in some cases, it may not always be about profit. Some of you may really want to see very good use cases get online, get mass adoption that will somehow indirectly benefit your economics elsewhere. How do you each measure the success? Are your funds auditable? Can they be audited? Do you talk about IRRs, annualized returns? Do you use that same traditional mindset and metrics to measure success? Maybe more so for the ones with maybe LP, like reporting obligations. You do have people you have to go out to and
sure.
disclose results.
I think for any fund manager, there's always 2 things, right? You're always constantly fundraising, or you got to do deep diligence looking at whatever projects you want to invest into, which is actually kind of contradictory, because if you're always fundraising, you can't really be looking at what your LPs pay you to do. But for us, exit, I love to tell you we love investing in blockchain for the world to grow a better place in 10 years. But at the end of the day, it's IRR for all our LPs. It doesn't matter what you invest into, crypto, blockchain, Polkadot, whatever project. But at the end of the month, what was your return? Well, because we're a hedge fund of funds, so our lockup is 2 years. We invest into funds like Metastable that lock up a year. So for us, it's monthly. We have reports to our LPs exactly how the market moved, what our return is, and outlook in the future, stuff like that. So it's very, very transparent with our LPs, and at the end of the day, it's all IRR. Yeah.
I think I totally agree on this. I think overall investment is about 3 things: return, liquidity, and safety. In most situations, we don't have safety problem. In some crazy country with dangerous situation, you may have the asset face safety problem. So that remains 2 questions is about liquidity and return. If you got enough liquidity and good returns, then means you are successful. If you calculate like help the kind of how to help the startup to grow, that's kind of like that's a way for you to help your investment to get more return. So eventually, it's all about like return and liquidity. So that's my understanding.
So we're still measuring by the traditional means, IRR, internal rate of return, and actual cash on cash, money in versus money out.
Right.
Yeah. Any other views you want to share?
Yeah, very much agree with James on risk control and investment returns, as those are the yardsticks for a fund, a venture fund. But also, I think very important for us is to stay competitive. Are we able to stay competitive in this industry as all these different players and coming and changing the dynamics? Would the top-notch team still willing to take our money instead of others' money? Are we able to be part of their growth? And contribute to that. And also, everyone knows this industry switch really, really fast. So we constantly ask ourselves, are we able to stay agile, stay sharp to capture all these opportunities or avoid all the pitfalls? Because it's so easy to get burnt in crypto. So I think that's the second layer of evaluation of success.
Of success, right? Yeah.
Yeah, I agree that too, because as an investor is investment, right? The same thing. So the return is very important criteria to evaluate the performance, for sure. But I think that the reason, or we are able to do something more early stage, more technology based, because we have a more broadened ecosystem, and we are able to support the deal itself, support the project, and provide them the way to grow better. So. But again, I think the performance and also return is most important criteria. Yes.
Yeah, and if there's something I actually do, I'm very curious. What does the internal rate of return or annualized return look like relative to, let's say, traditional venture? Let's put a top quartile IRR 60 to 200%, private equity 19 to 23, debt a little lower. Where do we place token funds so far, average? If that's even an appropriate question, I don't know. IRR and annualized returns.
What year are we talking?
Let's do a comparison because it has to be relative. So let's match up the year of the nice hype, 17, 18, and now. So winter last year, pretty good, 17, and this year, comeback. How's it look like?
I mean, Polychain returned 72x, right, in 2017. So how do you put any venture funds, Sequoia, KKR, compared to that, right? But at the same time, in 2018, I think, like I said, half the crypto funds that had less than 20 mil AUM probably died. So yeah, like it's really hard to benchmark. It depends on your risk portfolio. If you can ride with the polychains and the metastables through the thick times like last year in 2018, then in 2019, you can also get monthly 40 to 60% IRR. That's very, very normal. But I think for us, we started a quant fund vehicle because we realized in this space right now, there's just such a huge opportunity for the alpha on top of what people are doing. So there's a lot of great fund managers out there. We got Crypto Labs, there's QCP here in Singapore. They're a great prop shop, and they don't even take outside capital. But don't get me wrong, there's a lot of great VC funds out there, including one sitting here. I don't know if Libertas is in the room. So I think there's different strategies and different outlooks to the market to exactly how you want to deploy. And for us, kind of as a fund of fund, at the baseline, we're thinking about our LPs already portfolio and how we can allocate to them in a safe manner into this space.
40 to 60%. That's pretty. I mean, roughly on.
That's happened in I think May and June. There was 40% and 60% IRR monthly. Because when tokens go up 60%, right, and if 80% of your portfolio is holding some of these tokens, that's going to happen.
Right.
But at the same time, it'll drop 2018. I can just, I don't really want to fully disclose, but I'm pretty sure most fundamental funds were down more than 30 to 40%. Yeah, and so it depends.
How does that number sound to the rest of the folks here? That kind of return.
Right. I guess we have a different view on this for traditional equity fiat fund, right? We have a USD fund and we also have our RMB fund. And we know the IRR, the calculation for IRR is versus time.
Yes.
And most of the fund actually is a closed period. For example, it's for us easy to calculate because our fund is 5 years, 10 years. So it's easy to come out a number, even it's just on book. Okay, we can get the variation of the project on the marketplace today. And so for our traditional fear fund, well, say IR is something like 30%. Okay, annually, 30%. And we do have the digital assets fund. We call that now. We don't call token fund. And our token fund actually is 5 years. Not like some other token fund. Maybe some of token fund has no time limit. Okay, but for us, we do have agreement with LP. That's 5 years. And for this token fund, we do have IRR calculation. It's again, it's annual. It's above 100%, but I don't give the exact number.
Sure. Wow. And so kind of connecting to another question which came up here about fundraising schemes and strategy-wise, will there be a fundraising strategic competition between selling a 30, 40% very long track record VC kind of fund versus these pops? Like, hey, we're getting into above 100%. Maybe I should focus my fundraise on that story, on those type of IRRs, or we need both. It does go back to that scheme of traditional versus blockchain, but these IRR numbers are fantastic, so seems like, for tokens. I mean, strategy-wise, basically, to kind of also converge with my last question is, what is your pitch? What would be your pitch upcoming if you were to fundraise? How would you do it? What would you want to focus on? What do you want to talk about?
I guess for us, it's honestly, we're here for the long term. I know everyone here in the room is probably in blockchain, buys Bitcoin and is in it for the long term. But the reason Sequoia, KKR, Hill House, they're still around is because they've been there for 10, 20 years. They've been through multiple market cycles. So likewise, Black Panther Capital, crypto is about 10% of what we do. But we would like to be here in 5 years and can say, we're one of the top fund of funds with returns. So if you take that into perspective, you're looking at, safer, more risk-averse investments, but will not, when Bitcoin goes up 50% in one day, we won't be up 50%. We'll probably be up 10 to 20. But when Bitcoin goes up 80%, down 80% last year, we were, I think, down like single digits. So it depends how you hedge yourself, and for your investors especially.
And for the rest of you, if you want to fundraise, and give a 30-second pitch on what you want to focus on, IRR, or strategy, or macro directions, what would you say?
We don't raise from outside, but we have a few fund-of-fund vehicles, and what we're looking for into those funds are complementary resources, geographic presence, or expertise. So that's what we're looking for if we invest in other funds.
Yeah, sure. Last 20 seconds. Oh, actually, we're over, but any last words on that?
I think being a fund manager is, particularly in the long haul, is about able to deliver consistent results over time. I think that in certain years, obviously, some crazy return, which is awesome. But at the end of the day, to build a reputation, being a great VC long term, is to be able to show that you consistently result. So it's not just if there's one trend where everybody go there. I still want to be around 10, 20 years from now.
Right.
We don't do any fundraising and raise any outside capital. But if you do want to have investment by DFG, let me know about it. Thank you.
Sure. Thank you.
Well, again, as a old school venture capital, we keep the same thesis to looking for specific LP for the fund. So, yep.
Fantastic. We're out of time, but thank you to all my panelists here. That was a great discussion. And it sounds like, the takeaways here is everyone's here for the long term. There's serious money and serious intelligence and wisdom here around the space. It is evolving, so do feel free and to catch up with any of these panelists now. Thank you very much.
Thank you.
Thank you.